ACCA, Insolvency Law. Introduction. Welcome to Corporate and Business Law, focusing on insolvency law. In this video, we will examine the definition of insolvency and its legal implications, procedures for company liquidation, differences between voluntary and compulsory liquidation, the role of liquidators and order of debt repayment, rights of creditors and duties of directors in insolvency. What is insolvency? Insolvency occurs when a company cannot meet its financial obligations. Two legal tests determine insolvency. Cash flow test. Company cannot pay its debts as they fall due. Focuses on immediate payment ability. Balance sheet test. Company's liabilities exceed its assets. Focuses on overall financial position. Mathematical example. Company assets equals £500,000. Company liabilities equals £700,000. Deficit equals £700,000 to £500,000 equals £200,000. Company is insolvent under balance sheet test. Types of insolvency procedures. Several procedures exist to deal with company financial distress. Liquidation, winding up closure and dissolution of company. Administration, attempt to rescue company as going concern. Company voluntary arrangement, CVA agreement with creditors for debt restructuring. Receivership, control by secured creditor to recover debt. This module focuses primarily on liquidation procedures. Liquidation overview. Liquidation is the legal process to wind up and dissolve a company. Primary objectives. Sell company assets to raise cash. Pay creditors according to legal priorities. Distribute any surplus to shareholders. Formally dissolve the company. Two main categories. Voluntary liquidation, initiated by company or shareholders. Compulsory liquidation, ordered by court. Voluntary liquidation. Voluntary liquidation has two distinct types. Members' voluntary liquidation, MVL. Used when company is solvent. Directors make statutory declaration of solvency. Shareholders control the process. Creditors' voluntary liquidation, CVL. Used when company is insolvent. Initiated by shareholders but controlled by creditors. Creditors have greater influence over proceedings. The key distinction is whether the company can pay its debts in full. Compulsory liquidation. Compulsory liquidation is ordered by the court. Common grounds for petition. Company unable to pay its debts. Just and equitable to wind up the company. Company has not commenced business within 1 year. Petitioners may include creditors seeking debt recovery, directors in exceptional circumstances, shareholders alleging unfair prejudice, regulatory authorities. Test of insolvency statutory demand. The statutory demand provides evidence of insolvency. Key requirements. Debt must be £750 or more. Formal demand served on company. Company fails to pay within 21 days. Mathematical example. Debt owed equals £1,000. Statutory demand served on January 1st. Payment deadline equals January 22nd. No payment received equals evidence of inability to pay debts. Creditor can file winding up petition. Role of the liquidator. The liquidator takes control of the company's affairs. Primary responsibilities. Collect and sell all company assets. Investigate company's affairs and transactions. Pay creditors according to legal priorities. Distribute any surplus to shareholders. File required reports with company's house. Apply for company dissolution. The liquidator owes duties to creditors as a whole, not individual creditors. Priority of payments in liquidation. Creditors are paid in strict legal order. 1. Liquidators' fees and expenses. 2. Secured creditors with fixed charges. 3. Preferential creditors, e.g., employee wages. 4. Secured creditors with floating charges. 5. Unsecured creditors. 6. Shareholders, if any surplus remains. Higher-ranking creditors must be paid in full before lower-ranking creditors receive anything. Payment distribution example. Let's calculate distribution from company assets. Available assets, £100,000. Claims. Liquidator fees equals £5,000. Fixed charge creditor equals £30,000. Employee wages equals £10,000. Floating charge creditor equals £20,000. Unsecured creditors equals £50,000. Distribution calculation. Liquidator, £5,000, paid first. Fixed charge, £30,000, paid in full. Employees, £10,000, paid in full. Floating charge, £20,000, paid in full. Remaining for unsecured, £35,000. Unsecured creditors receive £35,000 divided by £50,000 equals 70% of their claims. Effect of liquidation on company. Liquidation has immediate and significant effects. Operational changes. Company must cease trading immediately. Directors lose their powers to manage. All legal actions against company are halted. Employees' contracts are terminated. Final outcome. Company name is struck off the register. Company ceases to exist as legal entity. Any remaining assets vest in the Crown. Duties of directors in insolvency. Directors have heightened responsibilities when insolvency threatens. Before formal insolvency. Avoid wrongful trading. Consider creditors' interests alongside shareholders. Take professional advice on company's position. During insolvency proceedings. Cooperate fully with liquidator. Provide company records and information. Submit statement of affairs. Attend meetings as required. Wrongful trading. Wrongful trading occurs when directors continue trading despite knowing insolvency is unavoidable. Legal test. Directors knew or ought to have known insolvency was unavoidable. Company continued trading after this point. Creditor's position was worsened. Consequences for directors. Personal liability for losses incurred after the relevant time. Disqualification from acting as director for up to 15 years. Requirement to contribute to company assets. Fraudulent trading. Fraudulent trading is more serious than wrongful trading. Requirements. Company carried on business with intent to defraud creditors. Deliberate dishonesty in transactions. Consequences. Criminal offense with potential imprisonment. Unlimited personal liability for company debts. Automatic disqualification as director. The intent to defraud distinguishes this from wrongful trading. Administration overview. Administration aims to rescue the company as a going concern. Key features. Moratorium prevents creditor actions. Administrator takes control of company. Focus on business rescue rather than liquidation. Possible outcomes. Successful restructuring and return to profitability. Sale of business as going concern. Better realization of assets than immediate liquidation. Company Voluntary Arrangement, CVA. CVA allows companies to reach agreements with creditors. Process. Company proposes repayment plan to creditors. Requires approval by 75% of creditors by value. Supervised by licensed insolvency practitioner. Binds all creditors once approved. Benefits. Company continues trading. Avoid stigma of formal insolvency. Flexible repayment arrangements. Receivership. Receivership is initiated by secured creditors. Key characteristics. Appointed by secured creditors with floating charges. Control specific charged assets, not entire company. Primary duty to secured creditor who appointed them. Focus on recovering secured debt. Distinction from administration. Receiver acts for secured creditors' benefit. Administrator acts for creditors generally. Conclusion. We have comprehensively covered insolvency law principles. Insolvency occurs when companies cannot meet their debts. Liquidation provides orderly closure and asset distribution. Voluntary and compulsory procedures serve different circumstances. Liquidators ensure fair distribution according to legal priorities. Directors face strict duties and potential personal liability. Alternative procedures like administration and CVA may preserve businesses. Understanding insolvency law is crucial for directors, creditors, and business advisors dealing with financial distress. Thank you for watching Insolvency Law.